It's been a golden decade for growth stocks. Largely driven by big tech and easy access to funds, they've outperformed value stocks over the last 10 years. The S&P 500 Growth Index shows annualized 10-year returns of more than 16.6%, compared to just over 10% for the S&P 500 Value. This accelerated with the onset of the pandemic, with lockdown measures and work-from-home orders benefiting companies in the tech and online retailing spaces. Among the biggest winners were the stay-home group of stocks, Netflix, Zoom, and food delivery services like China's Meituan. But that could be set to change. As economies reopen, investors are increasingly placing their bets on value stocks for 2022, cycling back to traditional sectors like energy, financials, and consumer staples.
The value stocks are tied very often to the old economy or the real economy itself. And most of these stocks, because of what happened during COVID, were sold down and became very undervalued, and therefore became quite good picks when the light at the end of the tunnel became quite obvious because of the vaccination and such.
Often seen as stocks on discount, value stocks refer to companies with share prices lower than their financial performance would suggest. They tend to be mature businesses with steady growth rates and potential to grow further, and can be identified by a low price-to-earnings ratio.
Typically, these companies are a little bit overlooked, not very fashionable, but the chances are that over a long run, the company may turn it around, they may overcome the current difficulties.
The success of vaccines at the start of last year prompted a rebound in value stocks through the middle of the year, before the Delta variant rattled markets again. With the global economy expected to recover further this year, experts say the time could be ripe to put money back into value.
What is lifting value stocks is not just specific to value, but is actually part of a larger boat that is lifting cyclical assets and sectors as well. So including, for example, commodities, real assets too, such as REITs and real estate.
Globally, sectors tied to the reopening of economies post-COVID are the ones to keep an eye on.
Number one is the energy sector. I think a lot of it is tied to how global economy is going to grow, or at least get out of this COVID recession, and how the energy demand from different sectors will look like. The other value sector, I would say, that's interesting to watch, I think, is airline, which is, again, everything is tied to the global travel, international travel, and how restrictions might loosen or tighten.
I think the main ones have been really repriced, if you're talking about hospitality, aviation, and such. So maybe I think now the rotation will go into other not so common value stocks, but still representing value. And these may be smaller sectors, SMEs, and such.
For banks and financials, their net interest margins would rise alongside the rising interest rate environment. The other part would be their share of tangible assets are also higher. So therefore, with the reflation, their assets, the real assets on their books also get revalued higher as well. We like not just the US, but also parts of selected Asia. Indonesia, that would be a value play because they are also leveraged to the commodities play. The Taiwan and India, where we see very strong corporate growth earnings from there.
But experts warn that just because something is cheap doesn't make it good value. Investors need to watch out for red flags, like inconsistent revenues, poor corporate governance, or out-of-date business models. Value investing also requires some staying power.
For those companies that's in trouble, undergoing transition, or being overlooked by investors for now, of course, the goal is to have a portfolio of them, and as their price rebounds sort of to the mean level, you make actual return. But it's very hard to pinpoint when this particular company will turn around, or when this industry will find a way out of its trouble, or when investors will come back to these type of overlooked stocks.
At the same time, It isn't the end of the growth story just yet. Analysts don't expect the emergence of new COVID variants to roil markets much in 2022. Given that populations are more vaccinated, the governments are better prepared. For the tech-heavy growth space, fundamentals remain strong, even though it may be a bumpier ride.
Volatility would be higher this year, given that interest rates are on the rise. And, because growth stocks are typically seen to be a long duration play. In other words, their earnings are derived from future years. So therefore, I think there is some sensitivity to interest rates.
We see a few themes which we feel are quite entrenched. Themes like climate change, decarbonization, and these entail a lot of growth-related stocks. So a lot of these themes, which we don't think are multi-year, we in fact think they are multi-decade themes. This is going to drive the overall trend.